Have you ever sat in front of your charts, furious after a losing trade and thought, I'll get it back. Just one more big position and I'll recover everything? If so, congratulations. You've just fallen into the first trap that destroys trading accounts faster than any news event. Here's the truth nobody wants to admit. Most traders don't lose their accounts because of bad strategies or market manipulation. They lose because of predictable psychological mistakes, mistakes so common that even veterans fall into them. It's not a lack of knowledge, it's a lack of discipline. And worse, these mistakes feel logical in the moment. Revenge trading feels like justice. Following the crowd feels safe. Using more leverage feels like efficiency. Picking a shady broker feels like a shortcut. But in reality, each one is a carefully disguised trap waiting to empty your account. The paradox is brutal. The more experience you think you have, the easier it is to get caught. Overconfidence blinds even seasoned traders. The market doesn't care how many years you've studied. If you fall into these psychological holes, it will chew you up and spit you out without mercy. So here's my promise. In the next parts, we'll break down the 4 deadly traps in Forex that wipe out accounts again and again. We'll expose the lies you tell yourself, the tricks the market plays, and the illusions that seduce you. And most importantly, we'll uncover how to protect yourself before it's too late. Because the question isn't, will you face these mistakes? The real question is, will you survive them? Revenge trading. Just saying the phrase makes every professional trader wince, because they've been there. You've been there. We've all been there. It's that moment when your carefully planned strategy vanishes in a cloud of anger after one bad trade. You take a hit, your pride bleeds, and instead of walking away, you slam the button again, this time with bigger size, tighter stop, or worse. No stop at all. You tell yourself, it's logical. The market owes me. I was right, just unlucky. I'll get it back. That's the lie that kills. Because the market doesn't owe you anything. It doesn't even know you exist. But your ego? It screams like a toddler denied candy, demanding redemption. And you obey. Let's dissect this. Why does revenge trading feel so irresistible? Psychology has the answer. Neuroscience shows that loss activates the same part of the brain as physical pain. That's right. A losing trade literally hurts. And just like touching a hot stove, your brain instantly demands relief. The quickest relief? Take another trade. Double up, hit back, regain control. It's not rational trading, it's dopamine withdrawal. You're not a strategist. You're a gambler chasing the next roll of the dice. Even seasoned traders fall for this trap. I've seen professionals with 10+ years in the market blow up accounts in a single afternoon because they couldn't stomach walking away after one bad loss. They didn't lack skill. They lacked emotional control. One trader once confessed, "I wasn't trading the market anymore. I was trading my anger." That's the heart of revenge trading. You stop trading the chart and start trading your bruised ego. Here's the ugly math. Suppose you lose 10% of your account. To recover, you don't just need 10% back. You need 11.1%. Lose 50%. And you need 100% just to break even. The more you chase, the further the finish line moves. Revenge trading doesn't just make you lose money, it traps you in a mathematical spiral that accelerates the destruction of your account. So what's the solution? First, awareness. You must recognize the urge when it rises. That voice saying, "Just one more, you can make it back," is not your edge speaking. It's your ego begging for validation. The professionals learn to walk away in that moment. Some have hard rules. After 2 consecutive losses, they stop for the day. Others size down automatically after a red trade. Some literally shut off the computer and go for a run. The key is creating a circuit breaker that prevents emotional capital from hijacking financial capital. Second, journaling. Not just your trades, but your state of mind. Write down what you feel when you lose. Do you feel the urge to double size? Do you start scanning every pair like a desperate detective chasing clues? Journaling shines a spotlight on patterns you can't see in the heat of the moment. Over time, you'll discover your triggers, those little sparks that lead to the forest fire of revenge trading. Third, redefine what a loss means. Most amateurs see red and think, I failed. Professionals see red and think, tuition paid. A loss that follows your rules is not a failure. It's a success. Why? Because it proves you respected the process. But a revenge trade that breaks every rule, that's the real failure. If you can flip this mental script, you defuse the emotional bomb before it detonates. Finally, discipline through risk management. Keep position sizes boringly small. Use fixed percentages of your account per trade. If your standard size feels too small, good. That's how it should feel. Because when losses are manageable, the temptation to chase disappears. Revenge trading thrives when losses feel catastrophic. If each trade risks 1% of your capital, no single loss has the power to trigger emotional meltdown. But let's be brutally honest. Even with all the rules in the world, you will feel the urge. That's the paradox. You can't eliminate emotion. You can only plan for it. The legends are not emotionless robots. They feel the same rage, the same panic, the same urge to click back in. The difference? They've built habits that stop their finger before it presses the button. So ask yourself, how many times has revenge trading cost you more than the original loss? How many times did you just try to get it back, only to dig the hole deeper? And most importantly, how many more accounts are you willing to sacrifice before you finally admit the truth? Because here's the reality. Revenge trading isn't just a trap. It's the #1 account killer. And if you don't cage that beast, it will cage you. In the next section, we'll expose another trap that hides behind charts and candles, liquidity grabs. Those sneaky moves where big players bait you into stop-outs, then run the market the other way. You think you're being smart. In reality, you're being hunted. Trap 2. Liquidity grabs. Liquidity grabs, it sounds technical. But the pain is brutally simple. The market fakes a breakout, wipes out your stop loss, and then shoots in the original direction without you. You stare at your screen and scream, why does it always hit my stop before running? The answer? Because you are the liquidity. Think of the market as a predator. To move, it needs fuel, and that fuel is your stop orders. The big players don't move in with your tiny lot sizes. They need massive volume to enter positions. And to fill those orders, they need someone on the other side. Who's buying when they're selling? Who's selling when they're buying? You are the retail trader who puts stops right under the obvious support or just above the obvious resistance. This is herd psychology at work. Most traders are taught the same textbook levels, and they all hide their stops in the same places. It feels safe, but to the whales, it's a buffet. When price approaches those levels, they push it just enough to trigger thousands of stops. Boom. Liquidity floods in. You're kicked out. They get the entries they wanted. Then the market snaps back, as if mocking you. You call it manipulation. They call it business as usual. Why does this always happen to you? 2 reasons: fear of missing out and illusion of control. You see price creeping toward a level and you want in, fast. So you place a super tight stop thinking you're being safe. Wrong. You just put a neon sign over your money. Or worse, you convince yourself, I analyzed this perfectly. This is the ideal entry. Guess what? Thousands of traders thought the same thing. And when the herd clusters, it becomes bait. So how do you escape? First, accept that the market loves to punish the obvious. If a setup looks too clean, too perfect, be suspicious. Second, study the behavior of price around stop hunt zones. Watch for fake breaks with no volume confirmation or sharp reversals right after a breakout. That's a signature liquidity grab. Smart traders wait for that moment to jump in, while amateurs are still dazed and crying about being stopped out. Third, rethink your stop placement. Don't hide it in the same closet everyone else uses. Give it some breathing room, or scale into position so if one piece gets stopped, the rest survives. Some pros even intentionally sacrifice a small portion of their position, knowing it might get hunted while keeping the core alive to ride the real move. But here's the truth. You'll never completely avoid liquidity grabs. No one can. Even veteran traders get clipped. The difference is they don't panic, they don't chase, they observe, adapt, and sometimes use the very stop hunt as their entry signal. Meanwhile, retail traders keep swearing, "Next time I'll set a wider stop," only to repeat the same mistake again. The lesson? In Forex, you're not just trading price, you're trading against collective psychology. And collective psychology can be exploited. If you think like the crowd, you'll die like the crowd. To survive, you must learn to think differently. In the next part, we'll tackle one of the deadliest traps of all, the one that has blown up more accounts in hours than any other mistake: excessive leverage. It promises fast profits, but in reality, it's a razor that cuts careers short before they even begin. Excessive leverage. If revenge trading is the emotional bomb, excessive leverage is the nuclear button. It looks exciting, it feels powerful, and it promises you quick riches. But let me break it to you. Leverage is not your friend. It's the sharpest double-edged sword in Forex. Used with discipline, it's a tool. Used with greed, it's a guillotine. Here's the paradox. New traders see leverage as opportunity. Professionals see it as danger. Brokers love advertising it. Trade 1-500, 1-1,000, turn $100 into $100,000 overnight. They don't tell you that the same leverage that can multiply your gains can also destroy your account in a single blink. Margin calls don't arrive with a warning label. They arrive like a thief in the night, swift, merciless, and final. Why does leverage seduce so many traders? Psychology again. Humans are wired for instant gratification. You don't want to grind out 2% a month. You want to double your account this week. You want the adrenaline hit of big moves. Leverage feeds that hunger. It whispers, "Go on, you deserve this. One good trade and you'll be free." But what it really means is one bad trade and you'll be broke. Let's talk math. If you risk 1% of your account per trade with low leverage, you can survive 20, 30, even 50 trades going wrong. Painful? Sure. Fatal? No. But crank up the leverage, and suddenly one trade gone wrong costs you 30%, 50%, or the whole account. At that point, you're not trading anymore. You're gambling with loaded dice, and the house, the broker, always wins. Professional traders understand this. They don't use leverage like a weapon. They use it like a shield. They rarely max out. In fact, many of them use less than the maximum allowed. Why? Because they know survival is everything. The goal isn't to get rich quick. It's to stay in the game long enough for compounding to work its magic. Amateurs think leverage will accelerate their profits. Pros know leverage accelerates their mistakes. I've seen traders blow accounts in minutes. Not days, not hours. Minutes. They went all in on a can't-miss setup, 50.1 leverage, tight stop, convinced this was the one, and then the market moved against them by 20 pips. That tiny move, which should have been a scratch trade, turned into total destruction. Their account went from full to zero faster than they could say margin call. And let's not forget, brokers love this. Many of them thrive on high leverage because they know it speeds up client turnover. The faster you burn out, the faster you deposit again. Some even help by widening spreads or slipping your orders during volatile times. It's not manipulation, it's business. They're casinos wearing suits, and leverage is their slot machine. So how do you defend yourself? Rule 1. Treat leverage as poison, not power. Just because your broker offers 1-500 doesn't mean you should use it. Stick to small lot sizes relative to your account. A good rule of thumb? If you can't sleep at night with the trade on, you're over-leveraged. Rule 2. Risk small per trade. Professionals often risk 0.5% to 1% of their account. Yes, it sounds boring. Yes, it feels slow. But that boring pace is what builds million-dollar equity curves. Blowing up accounts is exciting until you're broke. Rule 3. Focus on consistency, not jackpots. If you're using leverage to chase a lottery win, you're not trading, you're gambling. Real traders know the game is survival, discipline, and steady growth. Compounding doesn't care how fast you start. It only cares how long you last. And let's get motivational for a second. Think about the trader you want to become. Do you want to be the gambler bragging on social media about one big win, only to vanish a month later after blowing up? Or do you want to be the trader who quietly compounds year after year, building a career instead of a highlight reel? The choice comes down to leverage. I'll be blunt. If you keep abusing leverage, it's not if you blow up, it's when. And it will happen faster than you think. But if you respect it, if you use it wisely, it becomes a tool that amplifies your discipline instead of your destruction. So ask yourself honestly, is leverage working for you or against you? Because in Forex, the graveyard is filled with traders who thought they could tame it. And now we arrive at the fourth trap. You can master your emotions, you can survive liquidity hunts, you can even tame leverage. But none of it matters if the very battlefield you're trading on is rigged. And that's exactly what happens when you choose the wrong broker. Unregulated brokers. You could have the discipline of a monk, the patience of a saint, and the sharpest strategy ever tested. But if your broker is unregulated, none of it matters. You're fighting in a rigged casino where the house doesn't just hold the odds, it writes the rules. And spoiler alert, they don't write them for you. Choosing the wrong broker is like building a mansion on quicksand. At first, everything looks fine. The spreads are tight, the platform feels slick, and they're promising you the moon, bonuses, insane leverage, zero commissions. You think you've struck gold. But beneath the surface, your capital is already at risk. Not from the market, but from the very company holding your money. Let's be blunt. Unregulated brokers can and will manipulate price feeds. They can delay your executions, widen spreads when it suits them, and even hunt your stops internally. You think the market spiked? Maybe. Or maybe your broker just painted a candle high enough to wipe you out. Try arguing with their customer service about it. You'll get a copy-paste response that sounds like it came from a robot in a basement. And withdrawals? Good luck. The same broker that was lightning fast when taking your deposit suddenly develops amnesia when you try to pull funds out. Stories abound of traders waiting weeks, even months, only to be told their request was under review. Translation, they're stalling while deciding how much of your money they can keep. Why do traders fall for this? Psychology again. Greed and laziness. The promise of easy profits blinds you to the fine print. No KYC, instant withdrawals, sky-high leverage. It all sounds so tempting. But here's the truth. If it sounds too good to be true in Forex, it's not just suspicious, it's dangerous. Veteran traders know regulation is not a luxury, it's a lifeline. They don't chase the shiniest offers. They choose brokers under strict jurisdictions, the FCA in the UK, the NFA CFTC in the US, ASIC in Australia. Why? Because those regulators enforce rules. They demand client funds be held in segregated accounts. They punish brokers for misconduct. In other words, they provide a referee on the field. Without that, you're playing a street game where the guy with the ball cheats whenever he likes. But here's the twist. Even experienced traders get caught. They think, I'm smart. I'll take advantage of the crazy leverage and just be careful. Famous last words, because no amount of skill can protect you if your broker simply refuses to pay you. You can manage risk in the market, but you can't manage risk when your counterparty is corrupt. Let me tell you a story. A trader builds a $20,000 account at an offshore broker offering 1/1,000 leverage. He's careful, disciplined, slowly grows it to $40,000 over a year. One day, he tries to withdraw $10,000. The broker delays, then asks for additional documents. Weeks go by. Finally, they shut down his account for suspicious activity. His money? Gone. He didn't lose it in the market. He lost it to trust. And that's the hardest part. Losses to the market sting. But at least you can learn from them. Losses to a shady broker leave you helpless. You can't journal your way out. You can't analyze your mistake other than realizing you bet your future on a scam. That's why choosing a broker is not just a technical decision, it's a psychological one. It's about resisting the greed that lures you into traps. So how do you protect yourself? First, do your homework. Regulation matters. Check the license number. Verify it with the regulator's official website. Don't just take the broker's word for it. Second, test withdrawals early. Before you go all in, deposit a small amount, trade lightly, and try to withdraw. See how fast and smooth the process is. If it's a circus, run. Third, ignore the shiny bait. Bonuses, sky-high leverage, guaranteed returns. Those aren't gifts, they're traps. Real brokers don't need gimmicks to attract clients. They offer reliability, not candy. Finally, accept that safety is boring. A regulated broker might not give you 1,000 leverage or flashy bonuses, but they'll give you something far more valuable: the confidence that your money is safe. And in trading, peace of mind is worth more than any leverage multiplier. So ask yourself, are you really trading the market, or are you gambling inside a rigged house? Because no matter how good your system is, no matter how disciplined you are, if your broker is unregulated, you're handing your profits to someone who sees you not as a client, but as prey. And that brings us to the hidden danger behind all four traps: revenge trading, liquidity grabs, over-leverage, shady brokers. They're not just external problems. They're symptoms of something deeper: psychological blind spots. And in the next part, we'll uncover the silent killers that hide inside every trader's mind, even experienced ones, and how to fight them before they wreck your career. Here's the uncomfortable truth: even if you avoid revenge trading, dodge liquidity grabs, tame leverage, and pick a regulated broker, you're still not safe. Because the deadliest traps aren't the obvious ones. They're the silent psychological snares hiding inside your own mind. And the cruel part? They don't just catch beginners, they catch veterans too. Let's start with the most universal disease in trading: FOMO, fear of missing out. You see a candle ripping up the chart, and your rational brain whispers, "Too late, wait for a pullback." But your emotional brain screams, "If I don't get in now, I'll miss the move of the century." So you click buy seconds before the reversal. Congratulations, you just donated to the market. Why does FOMO sting so much? Because it's tied to identity. You don't just fear missing profit, you fear being left behind. You scroll social media, see other traders bragging about catching the move, and suddenly your self-worth is on the line. That's why FOMO isn't just a trading problem. It's a self-image problem. And the solution isn't chasing more setups, it's building the patience to sit out. Professionals know this. The money you don't lose by avoiding bad entries is often more important than the money you gain. Next, let's talk about overconfidence after a winning streak. Nothing is more dangerous than feeling invincible. You string together 5, 6, 7 winners, and suddenly you believe you've cracked the code. You size up, you loosen stops, you skip confirmations. Because after all, I can't lose now. And that's when the market humbles you with a slap so hard it erases all your gains. Here's the irony: losing traders fear losing. Winning traders should fear winning, because victory breeds hubris. That's why some pros actually reduce size after a hot streak. They know the danger isn't the market, it's themselves, high on dopamine, mistaking luck for skill. Then we have the trap of outsourcing responsibility, copy trading, paid signals, guru worship. You convince yourself that following someone else's alerts is safer. Less stress, less thinking. But here's the harsh truth: if you outsource decision-making, you also outsource growth. You avoid the very friction that sharpens you. And when the signals fail, and they always do, you're left with nothing. No edge, no confidence, no skills. Just dependency. The real traders you admire didn't become legends by following. They became legends by leading themselves. Another silent killer: paralysis by analysis. You load your chart with 12 indicators, 5 oscillators, 3 moving averages, and Fibonacci levels from 3 different time frames. Your screen looks like a Christmas tree. And yet, you don't pull the trigger, because every indicator gives a different signal, and you wait for perfect alignment that never comes. You tell yourself you're being careful. In reality, you're hiding behind complexity to avoid responsibility. Professionals simplify. They know edge comes not from having the fanciest tools, but from mastering a few tools deeply Amateurs crave complexity because it feels like progress. Pros crave simplicity because it creates clarity. If your chart looks like NASA's control room, you're not trading. You're hiding from action. And finally, there's the trap no one likes to admit. Trading for excitement. Let's be honest, many people don't come to Forex for financial freedom. They come because they're bored. They want adrenaline. They want drama. They want to feel alive. And what better way than risking real money on flashing charts? But here's the problem. If you trade for entertainment, you'll pay for that entertainment with your capital. Professionals treat trading like running a factory. Routine, boring, process-driven. The real thrill isn't the click, it's the consistency. It's watching discipline compound into results. If you want excitement, go skydiving. If you want profit, embrace the boredom. So let's tie this together. These hidden traps, FOMO, overconfidence, signal addiction, overanalysis, thrill-seeking, are not just beginner mistakes. They are human mistakes. They prey on fear, greed, pride, and insecurity. And unless you confront them, they will haunt you no matter how advanced your technical skills become. Here's the ultimate irony. The longer you trade, the more likely you are to fall into them. Because experience breeds confidence. Confidence breeds carelessness, and carelessness breeds disaster. That's why the legends don't just manage trades, they manage themselves. They journal their impulses. They take breaks. They know their triggers. They accept that discipline is a daily battle, never won once and for all. So let me ask you, how many times have you bought a top out of FOMO? How many times have you doubled size after a hot streak? How many times have you followed a guru signal you didn't understand, only to regret it? How many hours have you wasted tinkering with indicators, convincing yourself you were preparing, when really you were just procrastinating? If you're honest, the answer is too many. And that's okay, if you're willing to change. Because awareness is step one. In the next part, we'll tie everything together. We'll revisit the 4 deadly traps and the hidden psychological killers. And we'll uncover the one principle that unites them all. Trading success isn't about conquering the market. It's about conquering yourself. Let's be honest. By now, you know the truth. The Forex market isn't out to make you rich. It's out to expose you, to test every weakness, magnify every flaw, and punish every lapse in discipline. And unless you learn to face that mirror, your account will always be at risk. We've walked through the traps, one by one. Revenge trading, the emotional bomb that detonates when you let pride drive your mouse. Liquidity grabs, the predator's trick that turns your stop-loss into free fuel for bigger players. Excessive leverage, the guillotine disguised as opportunity. Unregulated brokers, the silent thieves who don't just rig the game, they own the table. And finally, the hidden traps of the mind. FOMO, overconfidence, blind copying, analysis paralysis, and thrill-seeking, the subtle killers that strike even the most experienced traders. Each of these mistakes looks different on the surface, but they all share one root: psychology. The market doesn't destroy you, you destroy yourself. And that's the hardest lesson of all. But here's the good news. Just as every trap is born from psychology, every solution is too. Revenge trading is beaten not by more indicators, but by discipline and circuit breakers. Liquidity grabs are survived not by perfect stops, but by patience and awareness of crowd behavior. Leverage is tamed not by greed, but by respect for slow growth. Shady brokers are avoided not by luck, but by due diligence and resisting temptation. And the hidden traps of the mind? They're conquered by one thing: self-awareness. Think of trading as a dojo. Every trade is a sparring session. Every win tests your humility. Every loss tests your patience. The market is not your enemy. It's your teacher. Brutal, uncompromising, but fair. It reveals your weaknesses so you can address them. If you ignore the lessons, you pay again. If you learn, you grow. And this is where the transformation happens. The amateurs keep searching for holy grails outside themselves. The professionals realize the holy grail is inside. Identity. The key isn't to become someone who trades. The key is to become a trader. A trader who respects risk, embraces discipline, and treats losses not as shame, but as tuition. Let me leave you with this paradox. The best traders don't chase money. They chase mastery. And in chasing mastery, money follows. But if you chase money directly, you'll always be its prisoner. So ask yourself right now, which version of you is showing up at the screen? The gambler, desperate for a jackpot? Or the student, ready to learn from every candle? The revenge-driven ego, or the disciplined practitioner? Because every click of your mouse is a vote for the trader you are, or the trader you want to become. Here's your challenge. The next time you trade, don't measure success by profit. Measure it by discipline. Did you follow your plan? Did you respect your stops? Did you control your size? Did you walk away when emotions screamed to click? If you did, you won, even if the trade was red. Because in this game, the scoreboard isn't today's P&L. It's who you become after thousands of trades. Do you want to be the trader who blows up and blames the market? Or the one who survives, evolves, and thrives? Not because the market was easy, but because you became strong enough to face it. The decision is yours. The traps are real. But so is the path out. And it begins not with the next strategy, the next course, or the next guru, but with the next choice you make. Right here, right now. Avoid these mistakes, and you don't just save your account. You save yourself from becoming another statistic in the 95% who never make it. Embrace the discipline, and you step into the 5% who survive long enough to win. Remember this. Your next trade isn't just a position, it's a decision about who you are becoming. And the market, cold and merciless as it is, will always tell you the truth. Make sure you like what you see in the mirror.